September Trading Strategies, brought to you by Charles Schwab.
Welcome to Trading Strategies for September. I'm Scott Gamm. All right, we've made it to the most feared month of the year for stocks. Yes, September is historically a down month. But hey, the data also said that August should be a rough month, and the S&P 500 bucked the trend this year, rising 3% in August. So what's in store for stocks this month and beyond? Let's bring in our panel of experts for the next hour. Christina Hooper is Chief Global Investment Strategist at Invesco. Alicia Levine is Head of Investment Strategy at BNY Mellon. Ann Milletti, Senior Portfolio Manager at Wells Fargo Asset Management. And Brian Levitt, Senior Investment Strategist at Oppenheimer Funds. Welcome, everybody. Thank you for being with me.
Thank you.
Thank you.
So I said earlier, of course, how September is a rough month for the markets, but let's put some numbers behind that. Since 1950, the S&P 500 has fell an average of 0.5% during the month, according to LPL Financial. Will this year be any different, Brian?
Well, I think the first thing we want to be clear of when we look at some of these seasonality patterns or the worst monthly return, of course, we've got Lehman Brothers included in that, so you've got 2008. And, you know, in this point, we would have been told to sell in May and go away, and the summer's been quite good. You mentioned August. So the reality is, I think what we always want to be focused on is more of the macro picture and less about what these seasonal patterns are. I'd remind investors that they put $100,000 in the market right before Lehman. It was $50,000 by the end of the year. Today it's $255,000. So I don't think we should be so focused on monthly patterns. What we have, of course, is tightening policy, concerns about trade, some flatness to the yield curve, and a strong dollar. So I would be worried if the dollar continues to strengthen. You might see some churn or volatility in the markets, but if you have a long-term investment plan, I don't think you should be so focused on September in particular.
Yeah, and as a portfolio manager, are these historical references, so to speak, losing credibility?
I think there's something that investors are always interested in, and certainly things that we look at too. But there's also things that tell you in a strong year, if you have a strong year leading up to September, September isn't always a weak month. So, history is history. It really can't predict the future. There's a long list of things to worry about in the marketplace. I'm sure we're going to get to some of them today. But I agree with Brian. If you're an investor and a long-term investor, you really have to decide, do you want to risk trading for a month and risk not being able to get back in? And so I always think you have to be right twice if you're making a trade on a month or sell in May and go away, some theory like that. That's just a historical marker.
Well, and some investors fear September because it's so close to October, and October is of course a bad month
right.
historically for the market. So Alicia, help us out here.
I agree with Brian and Ann. I mean, historical precedent aside, September and October are scary months. We do have the noise of Lehman Brothers, and we do have the noise of the other crashes previous century. And, the bottom line is, though, the market is the market. And what are the conditions today and what are the conditions moving forward? And that's what you should look at. And it's very clear that if you are comfortable in the asset class of equities, then you should not be trading around it right now just because there's an urban legend about September or October.
But still, Christina, there are plenty of investors out there waiting for an entry point.
Oh, absolutely. And this could be a very interesting entry point, at least in some areas of the market. I'm a student of behavioral finance, and I do believe that part of why historically we see losses in the month of September is because investors return their attention to their portfolios after taking a summer vacation. And so it's a time to scrutinize and perhaps hold stocks and portfolios to a higher standard. I would argue that coming back this year, investors are going to be pleasantly surprised if they're reviewing their portfolio in terms of the fundamentals for U.S. stocks. Now, having said that, I do expect more volatility, and I expect in particular a lot of volatility outside the U.S.
We just had the S&P 500 cross below its January high of 2873. We're now at 2870, down 0.6%. We were down the past two sessions. I guess, what is a good dip? How long should you wait? What kind of entry point is attractive in terms of a percentage drop in a stock, in an index, Brian?
Well, what we've seen is you have something like a 5 to 10% market correction in every given year. And we've had a few of these over the last couple of years. Investors don't really feel like we've had them because the market quickly goes back on its trend. I remember 2015 into the beginning of 2016, stocks were down close to 16, 17%. first Fed interest rate hike, strong dollar, and for a long time people were saying, when's it coming? Where's the correction? I was like, we already had it, right? So I think if you see markets down, 5-10%, we view that as standard operating procedure. And when I would really get worried about markets is higher and rising inflation in the United States. We're not there yet. An inverted yield curve, we're not there yet. High yield spreads blowing out, we're not there yet. A very strong dollar, well, that's the one that gives me some caution and why I'm looking so much at what the ultimate outcome of this trade, skirmish, war, whatever we're calling it.
Yeah, and I think Brian brings up a good point. I mean, if that correction we had earlier this year, if that's it, I guess it would be a good time to get into the markets now, or at least increase your exposure.
It would be. I mean, it's really tough to time the market. And we all know the economy has been strong. The market obviously is a predictor of the future, right? And so the market has been predicting, obviously, that things are going to stay pretty good. But we're going to see what the market thinks about the next 6 months. And it's hard to time that. So the way I think about investors putting money to work in the stock market is dollar cost averaging is probably still the best way to think about it. It's hard to be perfect timers. That being said, if we got a 10% correction, I'd look at that as a gift in this environment.
Although I wonder, though, what the likelihood of a correction would be in the final couple of months of the year, because the resiliency of this market has been incredible. And I wonder if that's because of corporate buybacks, that you have companies themselves in there buying their own stock anytime we see a dip, and that keeps a floor on stocks.
Corporate buybacks are definitely a very powerful force. But having said that, I actually think there's a pretty good likelihood that we experience a 5 to 10% correction before the end of the year. We just have a lot of different forces that are negative coming to bear on stocks. In particular, Fed policy continues to tighten. And we know from the FOMC minutes that participants are already starting to think we're getting very close to the point where we can't call monetary policy accommodative anymore. Then add to that, of course, the potential for trade wars to filter down into economic data as well as corporate earnings. I don't think we're that far away from that.
And we'll have more on the Fed in a moment, but Alicia, weigh in on this notion of corporate buybacks keeping a floor on the market.
So I think that's definitely a factor. The other factor bringing into the economy is that we have $700 billion that's going to be repatriated in 2018. When the tax bill was discussed last year, it was kind of unclear how much capital we'd actually see come back immediately. Turns out in the first 12 months, it's $700 billion. So this is also creating a nice liquid environment for corporates. In addition, what you find is that corporates are actually paying off some of their debt with the incentives embedded in the tax law. So you just have a very healthy corporate sector, and a healthy corporate sector leads to a healthier market.
So it sounds like you're saying we're in the early innings of the benefits of tax cuts.
I 100% believe this. I think that, it's old news from the sense of a headline in the newspaper, but in fact, it's early days for corporates and behavior and cash flow. And don't forget, corporates now have 5 years to immediately expense all investment, and all signs are that investment is increasing. We saw today that productivity is increasing. I think you're just seeing the beginnings of the benefits.
Yeah, Brian, do you agree with that? I mean, if you talk to the big auditors, the big accounting firms, they're still helping clients figure out what the tax law means. So how do we know what all the benefits are yet?
Right, so the benefits, companies are going to keep more of what they earn, companies are going to be utilizing more of what they earn, so that is all beneficial. I think in the broad aggregate, if we look at the macro numbers, we'll have a lot of government spending over the next couple of quarters. So it's likely that the economy will see a peak, and the economy will start to slow. But for corporate America, conditions continue to remain very good, keeping more of what they earn. I don't think the Fed can get overly tight. And multiples on stocks, while somewhat elevated, are really not that disconcerting. I mean, this is not 1999 by any stretch of the imagination.
Right, and corporate spending is definitely a key. And one of the things that we talk to management teams about when we're on the road, certainly something we've been hearing since the beginning part of the year, and it's showing up in the numbers. They really are putting money to work. And actually, I think that's been part of the driving force behind the tech rally, is when companies are putting money to work, a lot of it has gone into technology.
Tech rally, not this week, of course. It was a very rough week for tech. We have executives on Capitol Hill this week getting grilled about data security issues. Yesterday, the NASDAQ fell 1.2%. steepest decline since July. Today, we're down another 1% in the NASDAQ. Alicia, what's next for tech? Because it seemed as though we were past these regulation hurdles because we had other hearings on Capitol Hill in April, and here we are back again worrying about it.
So this issue is not going away. The previous administration decided that energy and financials were the area to embark on regulation. So that happened in the last 8 years. This administration, it looks like, may go after the tech sector in terms of regulation. That issue is not going away. Having said that, these are extraordinarily profitable companies, and a few percentage downdraft days are not going to take away from the fact that these are profitable companies growing very quickly, growing faster than the rest of the market. So they're attractive investments.
But maybe the stock prices need a re-rating if the growth is going to come down a bit, and that might be the concern, Christina.
Oh, certainly. But I don't expect growth to go down that significantly. I think much of this is actually political rhetoric, what we're hearing coming out of the administration, and really a lot of what we're hearing in these hearings. I don't expect a heck of a lot of regulation anytime soon, so I would expect earnings to be good, revenue to be good for a lot of these tech companies, and so any kind of significant sell-off represents a really interesting buying opportunity
Scott,
for tech.
It remains to be seen how addicted we really are to these things, and I'm just thinking, as Christina was talking about my daily existence, by the time I wake up, there's a member of my family on social media watching videos online. By the time I get home, there's packages stocked up. I don't know what more we need, but it seems like we're pretty addicted to these things, and these companies are going to continue to grow.
And when we look at the declines in Facebook over the past couple months, I mean, what should we do with them? Facebook's now down 7% so far this year.
I actually think we're getting to a point where it's becoming an opportunity to look at Facebook again. Look, it is a company that still has a lot of growth ahead of them. The core business is growing, but they have a lot of growth potential ahead in Instagram stories. That growth of the user platform is just accelerating faster than they even believed it could. But the monetization of that is just beginning. And then WhatsApp, there's some ability for them to monetize that as well. But their user base overall is strong, and their ability to get advertising dollars, advertising dollars are flowing to Google, to Facebook, to some of the other names away from traditional, and that's not going to stop.
Interesting, because I think that was the big worry with the data security issues, that maybe the advertisers would either ditch Facebook or take a pause.
Yeah, the interesting thing is, I think when the regulators, when even investors think about the heavy hand of a regulatory environment, and we saw this in financials, regulatory overhangs actually impact the smaller companies more than the larger companies because it's expensive. And larger companies that are growing quickly can afford it and can afford to deal with those hurdles. Smaller companies can't. And so smaller companies that were buying traffic from Google actually are the ones that are hurt more and even have been cut off because of concerns over Google's inability and Facebook's inability to control those privacy issues. And so it's those companies that have been hurt and squeezed already.
We talk about Facebook's woes. Of course, Snap, they have a whole set of problems on their own. The stock is now at a record low, under $10 a share. But you brought up Google a lot. Do you think Google is a little bit more immune to regulation issues? I mean, they weren't at the hearings on Wednesday.
Yeah, I think the empty chair with the sign was definitely the strongest signal that the regulators wanted to send. Look, I don't think any company can be completely immune from this. It was, the company's acknowledgments, not necessarily Google's, but Sheryl Sanders, the Twitter CEO, acknowledging that probably some regulation is not a bad thing, probably means that they're going to work to find a solution rather than one being invoked on them. And Google will be part of that as well. And so,
well,
Alicia?
A little bit what happened with the healthcare law, where you had the healthcare companies actually working with the administration to create the rules and regulations, because becoming part of the process produces a much better outcome. And that's what I heard in Sheryl Sandberg yesterday, which that she wants to have a seat at the table and to be part of the process. But just to reiterate something that Ann said, which is regulation tends to keep the large players intact and kind of prevents startups and prevents smaller companies from gaining steam. And so in a funny way, you may think you're solving one problem with regulation, but you could be causing another problem by kind of entrenching the original huge tech behemoths.
Yeah, but Christina, I mean, investors don't want to hear about regulation. They just want growth. So weigh in from that perspective.
Well, and I don't think they're going to see much regulation, but I think they're going to hear a lot about regulation at least until the midterm elections. So my advice would be watch the tech stocks. And if they continue to come under pressure, this represents a buying opportunity. Keep in mind, this administration is all about deregulation. So at the end of the day, I think they would be hard-pressed to actually ratchet up a lot of regulation in an area like technology, especially if tech companies have a seat at the table. So to me, this spells buying opportunity.
Yeah. And just one last point. I think the regulators also have to understand the efficiencies that are brought to the broader economy by technology, their ability for small companies to be created and exist because of technology is really important. And
I think that applies to Amazon. And we saw the president tweeting about Amazon earlier this year, and a lot of analysts said, well, he's not going to get much sympathy on that front because consumers love Amazon. It lowers the prices of pretty much everything they buy.
It does. It does. And I think there's always this, how much power is too much, right? So we all love it today. When you buy 90% of everything you buy from Amazon and they turn on you, is that going to be a good thing, right? That's the fear. But the beauty of it as an investor, I think about Amazon completely differently. And look, I'm a growth at a reasonable price investor, so I'm always trying to really think hard about the prices that I pay for stocks. Amazon is a very difficult stock as an investor to go in and say, this is an attractive valuation.
Now over $1 trillion.
Right. But the one thing, Amazon kind of breaks the rule. There's always stocks that kind of break your investment process rule. And the rule that it's broken for us is, in my career, it spans over 20 years doing this, Amazon really stands out to me is it's the unknown and what they have created while you don't even know it that's created so much value. So if you think about how they started, obviously kind of destroying the book world, right? And then creating an apparel business, the cloud business, transportation, logistics, automation. It's incredible.
And anytime a
built
report
billion dollars of businesses.
Anytime a report comes to the surface that Amazon is going to get into XYZ industry, you see the stocks in that group
the drug
plunge.
Right, exactly.
And so that says a lot.
Right,
And maybe, if you talk to Amazon about that, they would downplay that. Maybe that's just too much investor fear.
Right. But
I want to talk about the whole notion of $1 trillion market cap. Brian, does that worry you? Should we be at all afraid of this $1 trillion threshold that maybe valuations got a little bit too heavy?
I think there's an old quote that only small minds are impressed by large numbers. So I don't think I don't think we need to be worried about $1 trillion market cap.
Because Amazon's market cap was $600 billion in January.
You want to look at a price to a denominator. I mean, on a price to earnings basis, you might be concerned about the valuations on Amazon, but on a price to sales basis, you wouldn't be overly concerned about the valuation. So as an investor, you need to decide, do you agree with the management team and how they're investing back in the business? In my mind, price to sales is as good a predictor of future returns as any other valuation metric, typically better than price to earnings.
Even for Tilray?
And I said price to sales. I think a lot of that denominator is my kids and my family with all those boxes coming to the door every day. And as we all know, they're making a significant amount of money in web services. So again, that's for the stock pickers to decide, but there's nothing particularly worrisome about $1 trillion.
Alicia?
Look, not worrisome at all. The bottom line is that all that investment that did not go to the bottom line, in fact, helped build all this value in the real economy and how consumers act. So I think we can say they did actually a great job with the investments and the choices made, not listening to, oh, you've got to bring all this capital to the bottom line. So I'm not worried about the valuation at all. And I do believe also, having covered the healthcare sector for a very long time, these kinds of companies you value on a sales basis because the value comes in the investment.
And it's a really important point. I mean, I guess not all $1 trillion companies are created equal, right? Apple reached $1 trillion with a PE of what, 16, 17? Amazon reached $1 trillion with a PE of well over 150, right? So how do you balance that?
Well, that's a great question. I think what you need to do is make sure that you're very well diversified in your portfolio so that you can tolerate an Amazon in your portfolio in addition to a lot of other different names with growth potential. And so that's the beauty of having companies like Apple and Amazon, is that they do add to the diversification in a portfolio. And of course, we want to go well beyond just technology in a portfolio, but I am very excited about tech. I do think more and more CapEx dollars are going to go to technology, to your point, and my expectation is that that's going to continue to be a sector that is quite resilient despite what could be a turbulent couple of months leading up to midterms.
Christina did bring up a good point, though. I think the ability, the kind of the tailwind that Amazon did get a little bit has been the capital markets too, right? Capital has been cheap. Their ability to reinvest in other businesses, the market's been fine with that. But as rates go up, the market may change and say, we want something different. And so as an investor, we kind of value companies out on a private market value basis. If I were buying Amazon, obviously it's a $1 trillion company, it's hard to think that way, but we force ourselves to in every mindset. I don't just look at price to sales, right? If you're buying a company, you want more than one metric. You want to be sure you cross-check. So we look at least 3 different metrics and really try to understand, if I were buying and writing a check for that business, how comfortable am I that that can last? How sustainable is that? And I think the capital markets, has given them a tailwind, their size, and the capital markets will change, and that could become a headwind over time. But right now, it's been great.
Yeah, so the point on whether interest rates are going to rise, the way I view this playing out is short-term rates keep ratcheting up. I think we're going to flatten the yield curve, and you may ultimately see long rates come in. In my mind, a flatter yield curve typically means you want to pay up for growth because you're in a slow growth world. I think the time when value outperforms will be in the depths of the next recession and into the recovery. Typically, market leadership doesn't change at this point in the cycle, and I would expect technology to outperform. And of course, to your point, not one valuation, not one metric. You need to have a catalyst and earnings growth and everything else. My point was only to say $1 trillion is nothing.
Absolutely.
Well, I think for the race to $1 trillion, Microsoft and Alphabet are next. So maybe it'll be an ETF of all the $1 trillion companies.
Right.
And that could be something investors flock to.
Common Club.
Yeah, exactly, right? Well, it's interesting because when we talk about valuing stocks, maybe it's time to move away from FANG, look under the hood in tech, be a little bit more selective, and flock to the cloud stocks, which have had tremendous growth year to date, right? An average of 50% share price gains for, the Salesforces of the world, Splunk, VMware, Workday, ServiceNow, Adobe. These are all what Jim Cramer calls cloud kings. But maybe they're trading at lower PEs. I mean, how do you grapple with some, FANG stocks, which have been high flyers, versus cloud stocks, which maybe have better valuations?
The cloud has brought so much efficiency again to the world, and a lot of businesses. It's created a lot of efficiency. So it's certainly an area, when I think about places we want to be invested, that's certainly an area that's attractive to us. Amazon does also play in that space and kind of fits that bill as I think about a cloud company. So does a company like Equinix, which is a little bit, a different type of stock. So for investors who are looking to diversify a little bit outside of the FANG world, it's a REIT. It's a completely different type of name, but a share gainer in its space. Their backlog keeps growing at an accelerated rate. They operate across all networks, and they're a trusted source. And so it's a good name. It's a little bit outside of the box, but again, a different place for investors to go.
Yeah, there are so many arms of the cloud.
Exactly.
Aside from the traditional, infrastructure, there's the back end as well.
Exactly.
Alicia, weigh in on how you grapple with cloud versus FANG, high multiple versus low multiple.
So I like to stay away from stories that might have hair on them, and I'm not going to name names, but there are some stories in FANG with hair on them right now. And until the dust settles with that, I do think some companies have definitely gotten re-rated because of it. And the entry point is probably very soon. But I like the idea of going into sort of the next leg of growth for tech. In a funny way, FANG is a little bit looking behind us. If you think about Facebook, for instance, 2 billion users, hard to grow from 2 billion users. And so when you think about what's next, you want to be in the areas that are connecting businesses and creating efficiencies. And so I do think it's a better opportunity. It's more forward-looking.
Yeah, Christina, do you think some of these names are going from growth to value, and that's obviously a problem in and of itself?
Yeah, actually, where I see a lot of tech names going from growth to value is actually in China. The Chinese stock market has been beaten down a lot this year, and so for those who are really looking to bargain hunt right now, I actually would recommend fishing in that area.
I think we should transition and talk about market leadership, because that's so important, and I think people would be surprised to know that tech and consumer discretionary are actually largely tied year to date in terms of gains, about 17 and 18% for both sectors. So how is it that consumer discretionary stocks have done just as well as our beloved tech names, Brian?
It's been the tech names and consumer discretion names that have won since the moment Donald Trump won the presidency through yesterday. And I think a lot of investors early on in the aftermath of Trump's victory thought that was going to unleash a lot of value in the market, and a lot of the the names that had not been the outperformers would catch up. Now we've seen a run in financials, but it still continued to be tech and discretionary. A couple of things. There's a couple of big names in discretionary, that have generated significant growth. We've talked a lot about the tech sector, but there's also some surprises in the consumer space, and consumers doing well. I mean, we're in a pretty tight labor market. Wages are up modestly. I mean, not at a worrisome rate, but wages are up. Companies are keeping more of what they earn, and workers are benefiting somewhat from that. So the consumer names have held in well and done well.
Although we did get the ADP numbers this morning, 163,000 private sector jobs added in August. That was a big miss. Friday, we'll get the August jobs report from the government. And we remember the July report was a little bit light, 157,000 jobs added. Are these weaker numbers just a short-term blip in your view, Christina?
That's a great question. I don't know the answer to that, although I expect roughly around 200,000 non-farm payrolls, which I would argue is pretty strong for this part of the cycle. We've actually had much stronger than I would expect numbers for much of last year and this year, just given where we are in terms of how long this recovery has been. So I think all in all, it's a solid job market. But what I worry about is that trade issues, economic policy uncertainty will impact companies in terms of hiring decisions. So if we continue to see non-farm payrolls on the weaker side, and especially if it deteriorates from here, then we're going to want to really dive down into the numbers and understand what's going on, because we've already started to hear rumblings from companies that are nervous about this. And so that could be a sign, or it could just be a blip.
Although just from the market's point of view, if we do see that headline number a little bit weak, maybe that's good for wages, because investors don't like rising wages. It dings margins, right?
Right, and you're usually looking at 4 to 4.5 to 5% wage growth before investors get particularly worried. I think this is a good thing where we are now with wage growth. And quite frankly, if you look at the personal consumption expenditure, the Fed's preferred measure, we're not even back to the levels we were at in 2008. So while the rate of change is back in their perceived comfort zone, we're not even back at the level. So that's when I would be worried. I'd be worried if the Fed gets too tight in this type of environment, if they think that this wage growth is going to lead to an inflation spiral and they want to curtail this cycle. But in my mind, that we're not at that point.
Alicia, what do you think about the economy now?
So the economy looks great. I just want to go back to that ADP number. So the jobless claims actually were the lowest in 49 years. So just let's think about that for a second. So look, the labor market seems really healthy. It appears that certain marginally attached workers have come back into the labor force, I think also leading to the downward pressure on average hourly earnings. And also, younger workers earn less than older workers. So I think that's a little bit of what's happening with the earnings number. But on top of that, what companies are telling you, what CEOs are telling you, Target CEO said the best consumer he's seen in 30 years in the business. That is an extraordinary statement. These are not people who are used to hyperbolic, with all their lawyers all over them, to say something like that. And I think we should be listening to it, because 70% of the GDP number is consumption. America is shopping and eating out, and that is evident throughout all the numbers that you're seeing. Is it the peak? It could be the peak, but it looks like the numbers for second half GDP are actually rising and not falling. This may have legs. And it's tempting to say that we're at peak earnings, and it's tempting to say that we're at the peak economy. Maybe not. There are signs that this can go further. I will say to Christina's point, however, that the trade issue is underpriced in the U.S. market.
Investors are not taking it seriously.
Not taking it seriously. And in a funny way, the calming down of tensions with Mexico and Europe and with Canada, in a funny way, is bad news. Because it means that the China story is alive, and I believe that these tariffs are going to go through. And I worry about this spinning out of control. And because the U.S. market is not pricing it in, that's where I would worry.
Although it seems like the sort of agreement in theory between the U.S. and Canada, investors seem to have taken that as a sign that, well, if we can get a deal with Canada, we can get a deal with China. Is that jumping the gun?
I think it's jumping the gun. I think it's wrong, actually.
Christina?
Absolutely. What I would say is that China is preparing for a long war. There is no reason why China would acquiesce to what the U.S. is asking for. First of all, the U.S. is asking for a smorgasbord of things, including balance of trade being lowered, as well as intellectual property, market access. What I would argue is that the U.S. needs to be much more laser focused on what it really wants from China, so China knows what the key bargaining points are. But even if China knows that, I don't think they're going to give in, because they have a very large arsenal at their disposal to use. I would argue a bigger one than the U.S. has. Now, it may not seem that way. It doesn't seem that investors view it that way. They think in a U.S.-China trade war, the U.S. will win, just given where we've seen U.S. stocks and Chinese stocks going. But I would actually argue that China has a lot of tools at its disposal, and it also has a president for life. Whereas in the U.S., there's a much shorter term issue for the Trump administration. And so it's like apples fighting with oranges. There's a big advantage that China has.
Well, and Brian, I think Christina brings up a good point. The president's argument seems to be, well, if our economy is strong, now is the time to take on China. But that may not be the best sort of consequence for investors.
I agree. I mean, if you're running on this idea that we're going to deregulate industry, we're going to stimulate growth, the last thing you want to see is, globalization shift on its head, a trade war, tighter monetary policy, inflationary pressures in the United States. None of that would be a good thing at this point in the cycle. So, I think that's why investors have generally been sanguine. There's this idea that ultimately the administration backs away from this. We haven't seen it, and that is the big risk.
The administration is absolutely hell-bent on this, and they're not backing down.
And I agree to your point in that China's playing the long game.
And they have the ability to.
Yeah.
And really, the United States, this pursuit of bilateral agreements, which flies in the face of really free market principles. The Cato Institute has done a lot of work on this and how bad bilateral agreements are for the global economy. And unfortunately, they absolutely believe that this is the way they're going to pursue trade going forward. And that could have dramatic effects in terms of how long it takes to unravel all this, let alone what happens if this continues at this pace.
So can the U.S. win a trade war with China?
Look, I think there's certainly a chance. The odds are stacked up against them, and I think they were laid out pretty clearly here. But everybody has analyzed this. Certainly, we know the way the president negotiates. He wrote a book about it. He's been in business for a very long time. Most people would agree that this is probably not the way you'd like him to do and try to negotiate with China. But we'll have to see what the outcome is. And there's some probability that in the end, he'll acquiesce and give something and focus on what the most important issues are, and so will China. And it's good for both of our economies to do that, and so hopefully that's where we're going to get.
Scott, what we've seen so far is currencies adjust to reflect where we are. So can you win a trade war? Your currency will adjust, and your competitiveness will suffer. And so that's not a great thing.
And China has no issue with devaluing their currency to meet their needs.
I would suspect they don't. Christina's point, they have a lot of tools at their disposal.
So we've talked about the strengthening consumer, we've talked about trade. Obviously, anytime we've seen trade issues heat up, investors tend to flock to more domestic U.S. stocks like retail, and that sector is up 14.5% so far this year. I mean, who knew retail would be able to hold its own against tech, against consumer discretionary? Let's talk about retail. Christina, what's your outlook on the sector? I mean, is this kind of growth for real? Does it have legs?
Oh, I think it's absolutely for real. It has legs. We're seeing consumer confidence at a very, very high level from a variety of different metrics. And this is likely to continue. Again, my fear, though, is that what we could see, keep in mind that lower income Americans didn't get a lot in the tax break. So it's certainly been a positive for them, but they didn't get an enormous amount. And that could really be canceled out fairly quickly if there are enough tariffs on goods that they buy. And so we just need to follow this closely. If we just take one specific industry, washing machines, tariffs were applied on them in January, and we've already seen significant demand destruction. So we have a very healthy consumer now. I think that that health could be in jeopardy to a certain extent if we move forward with this. But for right now, the consumer's in great shape and is feeling very, very positive. So that's reflected in stock performance.
Alicia, how much of the success of retail this year has been about the consumer, and how much of it has been about the fact that a lot of the brick and mortar retailers are figuring out how to take on Amazon, right? You see the digital growth in Walmart and Target well above 40%.
So there's also a third reason to the two that you name, which is that they were left for dead last year. This entire sector was seen as a spiral downward, never to be resurrected ever again. Maybe Walmart would be the only company that could survive this. But yes, so the brick and mortar companies have figured out better ways of reaching their customer through tech, through the Amazon strategy in a funny way. There's no patent on strategy.
Sure.
And so if that's what the customers are responding to, they've gotten better. But also, it's not just the wage growth, it's also the fact that people are simply working. You go to small town America, and I've been in several places in small town America in the last 2 weeks. Restaurants are booming. Okay, shops are booming. Everywhere people are feeling better, and it's not just the coasts. And I think that's what's different today than it was maybe 6 or 7 years ago, where the coast really recovered much quicker. You just see a sense of optimism in the rest of the country.
And we know you like Amazon, but what else in retail are you looking at?
Retail has been strong, but I also think one important thing to point out is it has been a little bit narrow. And we've talked about a short-term phenomenon, but if you look over the last 3 years, really 30% of consumer discretionary stocks have outperformed the broader market. So a very narrow group of stocks has really caused the outperformance, and even this year and during the recent outperformance. And it's because of the secular challenges, right? So they're clearly, the market's saying there are winners and there are losers. So it makes it difficult for a stock picker to, you have to understand and really make sure you're positioned in the right companies, because it doesn't matter if retail's good if you are in the one that's bad.
What about Dollar General, up 20% so far this year?
Dollar General is a name I like, and it's a name I like for a couple of reasons. We talked about that lower end consumer, we talked about middle America. I live in the Midwest, so I see it. Unemployment rate in Wisconsin is nearing, it could break 2%. I mean, that's how low it is. It's just incredible. But there, rural areas and lower end consumers, it's not as easy. Amazon, Prime, getting stuff delivered to your door, other retailers giving that consumer what they need immediately, it's not as profitable to deliver to those customers. So Dollar General is situated in those areas, in those geographies, to serve those customers and their immediate needs. So whether it's a gallon of milk or low-end merchandise, things that those customers need, and their growth rate's been tremendous, their margin improvement's been good. So they're focused on an area of the market that is growing, that has good confidence, that has gone back to work, is seeing a little bit of wage growth, not a lot, because there's other pressures coming, but it's been a good place to be, and I think they've executed well and will continue.
Brian, can that sector lead the market for the rest of the year?
I wouldn't suspect that it would lead the market for the rest of the year, but I think what's actually shaking out in retail has been, we've sort of seen this over time, it's the lower end and it's the real luxury. and it's sort of the middle that gets squeezed out of this. And so you really have to be either an iconic brand that people aspire to, and that 400 million Chinese millennial population aspires to, and this massive young population around the world. I think there's going to be 3.5 billion people of labor force age in the emerging markets by 2030. And so those brands that people aspire to will do well, and the lower end will do well, that provide us the goods that we need at cheaper costs.
We haven't talked about the financial sector, up about 2% so far this year, which was actually a lot better than a few months ago when a lot of the big banks were in correction territory. Does everyone here agree that the banks are trading in tandem with the 10-year yield? And is that a correct sort of market action from investors?
So yes, so the banks are responding to the flattening of the yield curve. It's been heartbreaking in a sense, because and you would have expected, and many analysts, myself included, expected the financials to really benefit from the stronger economy and the healthier corporate sector. So the flattening is a negative. However, the banks are inexpensive and they're stable, and they are much better run in a way that than they were 10 years ago. And I actually think it's a great time to get into the banks. I do.
Christina, do you agree?
Oh, absolutely. I think there are a lot of attractive names, particularly the regional banks, and this is a good time.
And you like Webster Financial, that's a commercial bank. It's one that we don't hear too much about. It's up 16% so far this year, more than double the gain of JP Morgan Chase.
Yeah, it is. It's kind of one that's under the radar screen, and really in the banking world, it really is about deposit growth. They have really won that war, and it's a lot of it's because they have this HSA business, and HSA deposits are growing. That's a healthcare savings account. People are putting money in there, realizing it's a good way to save money tax-free. And so although you put it in there to save for your healthcare expenses, a lot of people don't even use it for healthcare and put more money in there. So their deposit base is growing. Obviously, rates increasing helps them as well. So it's a name that we think is a little bit under the radar screen, doesn't get the multiple. If you look at Health Equity, another name that is in that space, but obviously doesn't have the other, bank kind of type exposure, the multiples are so much higher.
Brian,
so.
do investors have it wrong on the financial sector to be so focused on the 10-year yield when there are other tailwinds facing the sector?
I don't necessarily think so. I mean, from a broad perspective, if we believe that the United States is going to get to a new, higher sustained level of growth, and we think the 10-year rate is going up along with it, then we want to buy the financial sector in aggregate. Now, obviously, there's going to be individual names we could parse, but in aggregate. If you're of my mind, which is to say that stronger dollar and tighter Fed leads to a flattening yield curve, that typically is not a tailwind to the broad financial sector.
But the 10-year hasn't really, it's up year to date, but it's still well below 3%. It really hasn't breached that level.
Yeah, I mean, look, and to me, the bond market gets it right more often than anything else. So what was the bond market telling us in early 2016 with 135 on the 10-year? Was that the Fed was pursuing deflationary policies in a very slow growth world. What did the bond market tell us on the run up to 311 after the Trump victory? Was that the bond market was expecting a new, higher sustained level of growth. What is the bond market telling us when it can't get above 3% and sustain it? That we're still in a slow growth world. And if the Fed wants to tighten in that slow growth world, they're going to flatten the yield curve, and usually that's not good for financials.
So do we think 2 more rate hikes this year, September and December?
I think it's almost a certainty that we'll see that September rate hike. I think it's far less likely we see a 4th rate hike this year.
Really? Even though the Fed guided in June that we would see that?
Yes. Keep in mind that dot plot was just moved by one participant, and it's only a policy prescription. It's a snapshot in time. And from my perspective, I think what we're going to see is a Fed that becomes more worried about the potential for an inverted yield curve. We've heard a lot of conversation about that. We've seen it show up in the FOMC minutes. We heard it at Jackson Hole. And I do think it's something that concerns FOMC participants. We also have a lot of turmoil in the emerging market space. And a lot of that, I would argue, is a result of Fed policy. So for many reasons, I expect the FOMC to err on the side of caution in December and not hike rates.
That's because a lot of the emerging market countries have debt denominated in dollars, and of course that debt becomes more expensive as the dollar rises and as the Fed raises rates. Is there risk that the EM crisis bleeds into U.S. markets, Brian?
No, I don't think that there's risk. I mean, what you're seeing in EM, to your point, is some capital flight as rates go up in the United States and the dollar strengthens, and then compounding it is some what I would still call idiosyncratic events in Argentina, Turkey, Venezuela. Argentina we've been dealing with for a century, so that's not a new story. Venezuela we've been dealing with for multiple decades. That's not a new story. Turkey is. It reminds us that if you go down the path of bad policy, the market's going to ding you. And President Erdogan tells us he's going to lower interest rates to combat inflation and appoints his son-in-law as the chief economic advisor. We see what happens to the lira. Now, Turkey's more tied in with Europe than the rest of the emerging markets. The rest of the emerging markets are going to be tied more into Chinese policy and China stimulating growth. Europe obviously is interconnected with the emerging markets and suffers some as EM does. And the United States is, we've got a lot of stimulus here, and the United States is able to withstand what's going on in EM right now.
And the Turkey issues that we saw a couple of months ago affected U.S. markets for a day or two, and it actually turned out to be a good buying opportunity, Alicia.
It did. I mean, it strengthened the dollar. But
it did, but I just want to point out that in the next 18 months, you have $700 billion of debt due in emerging market corporates. $700 billion in the next 18 months. So the stronger dollar is sending a lot of these credits into distressed areas. That's the first thing. The second thing, you've got $2.7 trillion that's denominated in US dollars due by 2025. So this is going to be, if this divergence between the US economy and the Fed tightening and the weaker rest of the world with quiet central banks continues, that stress of strengthening the dollar is going to hit all these EMs. It's not going to be isolated only to the countries that only have very large external funding needs.
I mean, it sounds like a silly question, but is that on the Fed's radar, especially the issue with U.S. corporate debt?
They say it's not, but look, I mean, to Christina's point, at the meeting last week at Jackson Hole, there was a lot of talk about the flattening yield curve, and I think the Fed is signaling that would be a reason they would pause. I tend to think they will do the December rate hike, only because I think there's a bit of a credibility. There would be a credibility issue after having signaled so strongly that we're moving forward. Here's our program. The economy's strong, not solid, but strong. I think to stop in December might be a bit of a credibility. I do think 19 will be a pause. 2019.
So no rate hikes in 19?
No, a pause and a reconsideration of where we are, taking into account the stronger dollar, the weakening emerging markets, and also the flattening yield curve.
And it may be time for the Fed to really spend some time focusing in on balance sheet normalization. That is accelerating as per the plan, but that's part of the disruption. And so I would argue that if they do want to hike rates in December, they need to dial back balance sheet normalization, because these are very powerful forces, both of them. Balance sheet perhaps even more powerful.
So it's not like watching paint dry, as Janet Yellen famously said a couple
years
ago.
No, it is not like watching paint dry, and there are some repercussions that are pretty significant.
Brian, do you agree?
I do. And, the way this all plays out, if the Fed doesn't want to back off because of what's happening in the emerging markets, the way it all plays out is the transmission mechanism is through the currency market. And if one of your primary goals is price stability, it'll show up as some deflationary impulses, and they'll back off.
And don't forget, the trade war that we're worried about with China will result in a weaker Chinese currency. I mean, that it's not just that it's a strategy, it's going to happen as the natural course of things, and the Chinese government's not going to stop it. So with a weaker Chinese currency, you then have risk all over emerging Asia.
All right, so we'll watch the Fed for the next couple of months, but do you think any kind of pullback that we do see is triggered by the Fed, or worries about what they're going to do or what they're not going to do? Or will it be triggered by some sort of midterm election outcome? Because that's the other sort of wild card that the markets need to be watching for the remainder of the year. And we'll go to you on that one.
Boy, politics have played a role in so much of what the news is focused on, but it's almost like the market's been in a closet and shut off the TV and is not looking at any papers and is just focused on the results in the economy and what direction that's been in. I do feel like, though, the midterm elections are important because it is the direction of the change that the market is going to be focused on, and whether or not deregulation and some of the plans that have been put in place can continue to move forward. And are we on this President Trump plan, or is that plan going to change? And I mean his economic plan. So I do feel like it's important. It certainly could disrupt the market, but it's not something as a portfolio manager that I can spend a lot of time trying to figure out what that means on a stock-by-stock basis. And as an investor, I think that's very, very difficult as well. So it's more, you have to figure out what you're comfortable with your allocation being today and wait it out.
Historically, gridlock has been better for markets than not.
We hear that a lot.
We hear that. We'll say that and then we'll leave that aside. I think the risk that happens now is, and all personal politics aside, is if the Democrats get control of the House, which the betting odds suggest today they will, and investors should take that with a grain of salt. We know that from 16. You could be looking at going down impeachment proceedings for better or for worse. And so if you look at the 3 times that's happened, I mean, we don't really have a lot of data on Andrew Johnson, so we look at Nixon and we look at Clinton. Nixon, from the time of the Saturday Night Massacre to when he resigned, the market was down 40%. Hold that thought for a second. When Clinton was president, from the time Monica Lewinsky agreed to cooperate with the special counsel to the time Clinton admitted to misleading the country, the market was down 19%. By the end of Clinton's term, full-term market was up 82%. So it was a blip. Why was it worse in 73, 74? I'd argue because inflation went from 4% to 11%. So I don't think we're going into a 40% correction in markets. Could you experience a downturn if there's concerns about impeachment? Sure.
So those are great points, but Christina, I think to Ann's point, how do you even deal with all of those outcomes, all that uncertainty? It sounds like you really need to just tune it out.
I think you absolutely have to tune it out and think that there's the potential for a silver lining. Because I would argue that we've gotten much of the best of the Trump administration agenda already in terms of the tax reform package. And so if the Democrats take the House, I don't think that's going to change very much the path of deregulation. But what it could do is perhaps slow down the path of trade wars. Because you could have some investigations that preoccupy the administration, divert attention away from their laser focus on trade wars. And of course, you could see the potential for the president deciding to do a deal with Democrats and getting infrastructure, which could be the other big stimulative package we could get. So I actually think there could be some positives if Dems take the House, not the Senate, but if they take the House.
Alicia?
Yeah, as long as the Senate stays Republican, and it looks like it will just because of who's actually running in this election cycle, I don't think it's going to be a big change. And I just want to remind everybody that this market has been incredibly resilient yes. to daily, even hourly disputes coming out of Washington.
It literally seems like it changes every hour.
It changes every hour. And what the market is telling you is that it's healthy. So, you may get some momentary weekly kind of reactions to it. I am concerned on the trade front because I do think that if the House goes Democratic, that in fact the administration will focus more on what it can do with executive action, and that's trade. But
that's a good point.
But the thing is, like, the market's telling you it doesn't really care that much. It's focused on fundamentals, bottom up, fundamental research, know what you own, be comfortable in your asset class, and go from there.
And earnings, of course, this year, right? The past 2 quarters were at 25% earnings growth year over year. I think the estimates are similar for 2019, maybe a little bit lower, but still very impressive. Brian?
Yeah, I mean, global growth is reasonable. Policy in most parts of the world is reasonable. Companies are keeping more of what they make via the new tax code. Earnings growth will continue to be solid.
Ann?
Yeah, I think inflation is something that I still spend a little bit of time worrying about. But I also know, doing this for a very long time, that it's the things that I have not yet thought about that are probably the things that are going to cause the surprise. And that's typically what it's been my entire career. So things that we're not talking about today, those will be the things that probably will cause the most distress to the market.
So examples of that could be?
I mean, certainly the terrorism we saw in the past, has created problems. But I don't know. It's the unknown, Scott. I mean, it's
These
the
black
things.
swan
Right.
events.
Exactly.
Right, that's true, very true. I agree with you. The markets react to surprises. And if you're talking about all these issues, it's not going to be the issues we're talking about. It's going to be the thing that we're not talking about and that investors are not considering.
So ignore everything we've talked about over the past 54 minutes.
Ignore it. But no, look, it's an interesting place. I do think there are issues of contagion from the emerging markets and from China through the currency that I do worry about, and I worry on the debt side. Who holds that debt? Who are the creditors, and who's going to be hurt when all these corporates in emerging markets can't pay back their dollar or euro denominated debt? That's what I worry about.
Christina?
Well, I guess what I would say is that in this environment with fundamentals that are solid in the U.S. and also fundamentals solid in other parts of the world, I would take advantage of any dip. Certainly there are some stocks, some regions, some sectors that will be all painted with the same brush. But that's an opportunity to really dive down, do homework, be discerning, and pick up hidden treasures, so to speak.
And Scott, I would say that this isn't a total waste of time, because as an investor, you do need to figure out what are the guideposts that you're looking for, right? What are the things that I should be paying attention to? So as we've talked through all of these issues today, there are certain things that you want to make sure, are they getting worse, are they getting better, right? And it's on the margin that things can change. And if you're getting more uncomfortable with those things in the direction they're going, you can change your allocation.
All right, we have a couple minutes left. I want to put an exclamation point on this whole hour and get everyone's final market call for the rest of the year. It could be about a stock, a sector, a macro factor. Brian?
This cycle is going to continue far longer than people think, so it's going to continue through the end of this year. Market leadership typically doesn't change at this point of the cycle. In my mind, it continues to be a growth in a slow growth world environment. Investors are going to be willing to pay up for growth wherever they can find it in all different parts of the world.
So no reason to worry about the longest bull market in history, which was achieved a few weeks ago.
No reason to worry until the warning signs are here. They're not here yet.
Anne, your last market call for the rest of the year?
Look, I'm a bottom-up stock picker, and I am always reluctant to make a call on where I think the market's going to be. But when I look at historic cycles, this one has been a long one, but the cumulative return has been less than many other cumulative cycles in the past. And fundamentals continue, the economy continues to gain momentum. If that continues, I think that we have room to go. And yet, if you look at the press, I think Fortune had a cover story that, said the end is near, the Wall Street Journal, Barron's. I mean, there is real fear out there, and that's not necessarily a bad thing, but it also could mean that there's real opportunity. So instead of the black swan event, there's really a chance that this could be a golden opportunity for investors too. So I think there's still a place for equities in your portfolio today.
Yeah, well, we always hear about how this is the most hated bull market, and now it's, of course, the longest.
Yes.
But I think that sums up your point pretty well.
Yes.
Alicia?
EM is cheap. I think it's getting cheaper, so I think it's still too early. I worry about Europe simply because of the financial sector and the exposure to the debt side of things, and I think that there could be some problematic credits and debt hidden in the European banks, so I worry about that. The U.S. is not in the ninth inning. It is much earlier than that. It is convenient to say that this is the longest bull market and therefore it's time to die. Again, it's another urban legend. This doesn't mean anything. There are no signals that we're headed towards a recession, and there are no signals that there's weakness in the labor market. Until that happens, bottom fundamental research and know what you own and why you own it.
Well, your first point on international stocks, it is incredible to see the divergence between
That's right.
the two areas. Just in this past, 7 months or so, it was a much different story in 2017.
Right, and look, it was based on the macro essentially. It was, emerging markets in Europe were growing faster than the U.S., and so the returns in those regions actually were pretty terrific. What happened here is in February, the market woke up to the fact that actually we have a pretty high growth economy. That's when you had that trembling in the market, that 10% downturn was about higher rates, the risk of higher inflation, and holy cow, it's here. It's not the rest of the world. And that's when you saw the divergence in performance start. It was that beginning of February.
Christina, your call for the year?
So my call is I expect more volatility, and that includes downside volatility for the rest of the year. And so that necessitates that investors do two things: be extremely well diversified, and that includes an adequate exposure to alternatives. But also investors should use this as an opportunity to be bargain hunting, but in a very discerning way. So this is not a time to be an index investor, but there are opportunities in the emerging market space, and in particular I would say Chinese tech, and there should be some opportunities in U.S. tech as well as we move through the fall. So this is a time to be thoughtful, discerning, selective, and keep one's eyes open as the dips occur.
Okay. Guys, thank you so much. It was a fascinating
you.
conversation over the last hour. Thank you.
Thanks,
Thank
Scott.
you.
Thank you.